Mark Cuban is an entrepreneur. He first started Micro Solutions, which is a computer consulting service business in 1983, which he sold to CompuServe for $6 million in 1990. And following his exit, Mark decided to buy an American Airlines unlimited air pass, and he traveled the world and partied like a degenerate, he says. But in 1995, he and his business partner, Todd Wagner, founded broadcast.com, which was the first internet radio streaming company, which got him to his billionaire status when he sold to Yahoo in 1999 at the peak of the dot-com bubble. And I'll go into a little bit of a case study into that in a bit here. Now, he also started Cost Plus Drugs in 2016, which aims to make pharmaceutical drugs more affordable for Americans by pricing them with a flat 15% fee on top of the wholesale prices. So that's actually, something interesting that he's doing. And one thing that he said on the podcast is, years before it was always, people would approach him in the street. Wow, I saw you on Shark Tank. You're awesome. Well, now it's kind of shifted where people are coming up to him and saying, wow, I was paying $2,000 for this cancer drug. I'm now paying, $20 for it. Thank you so much. So that's an interesting thing that he's doing. And then other than being an entrepreneur, Mark is well known for being an investor and TV personality on Shark Tank. And of course, is the owner of the Dallas Mavericks, which he purchased in 2000. And if you actually go to his website, markcubancompanies.com, you can actually see all of his private investments there. And according to Forbes, in 2023, his net worth was approximately $4.6 billion. So looking at a few of his publicly traded investments, which he disclosed, he indicated that Netflix and Amazon are two of his largest stock holdings and that he likes both because of their artificial intelligence capabilities. And in 2021, he stated that he believes Netflix and Amazon will outperform the S&P 500 over the following 10-year period. So we'll see if he is right about this, moving forward. He also invested heavily in Twitter before it was eventually bought out and taken private by Elon Musk. And Mark has been very critical of Musk as he believes that Twitter, or now called X, is much worse now with more bots and trolls on the platform than ever before. Mark's also invested in cryptocurrencies, including Bitcoin, Ethereum, and other stablecoins. And I think that this is actually pretty interesting. Mark actually got about $870,000 stolen from him or hacked from him from his crypto wallet when he accidentally downloaded a fraudulent version of MetaMask, which is one of the most common crypto wallet managers. So they, of course, got his login information and that money's gone. So that's too bad, but just kind of a public service announcement. Make sure that you're downloading the right app and it's not a fraudulent one. And lastly, just looking at the Dallas Mavericks here, given a $3.3 billion fair value estimate from Statista, Mark has done quite well with his investment in the Dallas Mavericks NBA team, which he purchased for $285 million in 2000. So now I kind of want to switch gears here and look at the case study of how Mark got to his billionaire status during the dot-com bubble. So as I mentioned previously, Mark started broadcast.com back in 1995 with his friend Todd Wagner when they realized that they were unable to watch or listen to the Indiana basketball games. So they had the idea to disrupt broadcasting by streaming content online. And as you can see here, I've got the financial statements from, or the annual financial statements from 1996, 1997, and 1998 here up on the screen. The company's revenues were growing at a good pace, generating about $22.4 million in revenue in 1998. But the company was losing money hand over fist with a net operating loss of $18 million and an earnings per share loss of 52 cents per share for the year. Now, despite the company, the company went public in July of 1998 at a price of $18 per share, and it quickly became known as one of the most high-flying IPOs in the history of the stock market, as the stock soared 250% to about $63 on the first trading day. And up to this time, no other stock in history had ever rose so sharply on its first day of trading. And of course, we're excluding penny stocks there. So, under 1 year later, at the tippity top of the tech bubble on April 1st of 1999, Yahoo purchased broadcast.com for 5.7 billion in Yahoo stock, which equates to a price to sales multiple of well over 200 times sales. And as you can see here, the Schiller PE, which I have up on the screen here, its highest ever point took place just a few months after this acquisition was announced in December of 1999. So again, Yahoo literally made this purchase months before the stock market valuations were about to collapse. And if we look at what Yahoo was trading at during this dot-com mania, at this market valuation peak in December of 1999, Yahoo was trading with a whopping PE multiple of over 1,000 times. But yet analysts were justifying the premium. And as you can see here from this article on CNN Money from December 7th of 1999, this individual is justifying this premium here. Now, luckily, Mark, who had received Yahoo shares, understood that he better hedge the potential downside risk of Yahoo stock. So he worked with Goldman Sachs to craft a collar trade where he bought put options to protect the downside and sold call options to offset the cost of the puts, but also which limited further upside if Yahoo climbed higher. And luckily for him, this hedge ended up saving him his 1.4 billion. So that's kind of the case study. Now, I'm just going to go over and finish with a few quotes from Cuban here. Number one, he says, now, when we got broadcast.com going, if the internet stock market hadn't been insane and been this big bubble, I wouldn't have made as much money. Now, like I was saying earlier, generally, I see Mark as a bit of an arrogant or brash individual sometimes, but I like that he is honest here and clearly understands that he wouldn't have become a billionaire, or most likely wouldn't have become, if it wasn't for some dumb luck involved with the timing of the tech bubble. Number two, don't be afraid to make mistakes. I learned some expensive lessons when I first started trading stocks. It was painful, but I tried to learn what I got right and wrong. And, I've brought this up before. I think that journaling is important, your trades, or at least kind of looking back at what you've done, what worked, what didn't work. Because again, I think that it's important to learn from your mistakes in the stock market. We're all going to make them, but it's crucial to look at your past actions. Now, number three, I like this quote because it's right in line with Keystone's philosophy on the broken model, where big bank advisors and analysts typically over-diversify their clients in hundreds or thousands of stocks in fee-heavy portfolios. So he says, the number one job of the hedge fund manager is not to make sure that you can retire with a smile on your face. It's for him to retire with a smile on his face. And last but not least, he says, in my opinion, right now, there's way too much hype on the technologies and not enough attention to the real businesses behind them. I thought that I would end with this quote, as at the end of the day, just like Yahoo paying over 200 times sales for broadcast.com, there was way too much hype on the new technologies of the internet and not enough focus on the real fundamentals of the business behind them.
It's really good job you did there. I actually found that interesting. There's a lot that, I've watched a fair bit of Shark Tank as well, so I know Mark Cuban from that. But there's a lot that I learned about him there. So, and certainly he was lucky. The timing was lucky, but luck is where preparation meets opportunity, right? So he went out there, he started up a business, happened to be in an ideal time. But when you look at guys like Cuban, I think he had said before, had he not been born and at a certain age, had he not been at that age starting his businesses at that time and been lucky, he would probably not have been a billionaire, but he still would have been a successful business person.
Yeah. Yep. I think he funded and kept broadcast.com alive. He funded about $1 million into it. So if he didn't have $1 million burning hole in his genes to be able to do that at that time, he wouldn't have been able to do it. So I did find it revealing that you called the market at a tippity top too, Brennan. So thanks for the tippity top reference there. Top. But no, I think it had 100. Broadcast.com at that point in 1999 had about 100 million in revenues, not profitable.
So
and went for about 57 times revenues at 5.7 billion. And like paying 5.7 billion for something that never made a dime in profit and just bled cash flow.
Yep.
That could only happen at one other time. So definitely lucky. But like Aaron said, he probably would have made probably not the capital that he made, the roughly 2 billion that his stake in that was, which allowed him then to, buy the Dallas Mavericks and have a tremendously strong investment in that company. But a confluence of factors has to occur for you to get that much wealth in one pop. And the markets had to be going insane. And he had to make that smart move with the options because he got shares, as I understand, right?
Yeah,
it was just shares.
correct.
If he did not make that, Yahoo, if you look at the share price of Yahoo after plummeted like precipitously, really. And with the smart move there, probably got good advice from someone. Maybe he knew to make that move himself. But, if I was getting 1 point something billion in a company that had Yahoo itself didn't have the greatest history of revenue. I mean, there was revenue growth, but the profitability was lacking, right? So like you're getting that. I'd be happy with that money. If there's any way, and some financial advisor or something told me I could just save, I could lock in that level of profit, basically. You do that in a heartbeat. And he listened and didn't, go for, I'm going to get 10 billion. Like I'm just going to keep it in here and make 10 billion. I think the 1.7 was a good enough start for him.
And I think it's so interesting too that, as he was hedging, potentially predicting that, maybe the stock market or Yahoo's price would fall, you have this analyst, this Schroeder analyst, Arthur Newman, who was increasing his price target at this time, literally at when the market was at the tippity top.
Well, he was probably doing financings for Yahoo.
Yeah.
Of course
exactly.
Or hope to be, right? Yeah, for sure.
Yeah, or his firm was
covering them and hoping to do it. Yeah, for sure. That's kind of the way the industry works that people don't talk about a lot. But